You know, people always ask me how Renaissance Technologies makes billions while the rest of the world struggles to beat the market. And honestly, the answer is deceptively simple: data. That's right. Not intuition, not fancy market predictions, not gut feelings. It's data, lots and lots of it. When I started thinking about patterns in the market, I realized that human intuition is limited. We're wired to see stories where there are none, to follow the news, to chase trends. But numbers don't lie. Patterns in numbers reveal opportunities that are invisible to the naked eye. That's the real secret. And it's not just any data. It's incredibly detailed, granular, sometimes even obscure information that most people would never consider important. You have to be willing to look where no one else is looking, to collect and organize data in ways that most people think is pointless or too tedious. Data has always been the real foundation behind everything we accomplish, but most people misunderstand what that actually means. When I say data, they imagine a few spreadsheets, some charts, maybe a handful of indicators. But the truth is far bigger, far deeper, and far more powerful. Data is simply the world written in numbers. It's human behavior, market reactions, price fluctuations, economic shifts, all translated into something measurable. And the moment something becomes measurable, it becomes analyzable. That's where the magic begins. Because when you remove the stories, the noise, and the emotional clutter that people attach to the market, what you're left with is pure signal hidden within chaos. That signal is what we spent decades learning how to detect. People forget that intuition is nothing more than accumulated experience mixed with personal bias. It's subjective, it's emotional, and it's incredibly unreliable in a domain as complex as the financial markets. I understood early that the market doesn't care how smart you are, how confident you feel, or how convincing your theory sounds. The market reacts to forces far bigger and more intricate than any one person can process. That's why data became our anchor. It doesn't argue, it doesn't get tired, it doesn't fall in love with a particular theory. It simply tells you what's happening, whether you want to accept it or not. And to me, that honesty is priceless. What most people miss is that the market is full of repeating behavior, but those repetitions aren't obvious to the naked eye. They're buried beneath layers of randomness. Human intuition will never see them. Your instincts might catch a trend once or twice, but they won't see the statistical pattern that appears 1 out of 1,000 times in a very specific set of conditions. But data will. If you study enough of it, clean it, organize it, and test it rigorously, it will reveal patterns that no human mind could ever notice on its own. And those tiny patterns, those faint signals hiding in massive data sets, are where the real money is made. When I talk about making billions, people think it must be some grand insight or revelation, but it's the opposite. It's millions of tiny insights extracted from oceans of information. It's the humility to admit that you don't know anything unless the numbers prove it. It's the discipline to run experiments over and over until the truth emerges. It's the patience to build systems that learn from the past without becoming trapped by it. That's the real work. That's the real secret. It's not glamorous, it's not dramatic, it's precise, mathematical, and relentless. The reason data works so well is because it frees you from yourself. It frees you from fear, greed, excitement, and panic. Once you trust the numbers more than your gut, you stop making impulsive decisions. You stop chasing headlines. You stop reacting emotionally to market swings. You start behaving like a scientist instead of a gambler. And over time, that shift changes everything. It creates consistency where others have volatility. It creates clarity where others have confusion. It creates stability where others are constantly spinning in circles trying to guess what comes next. So when I say data is the foundation of making billions, I don't mean it in some metaphorical way. I mean it literally. Data became the lens through which we saw the world. It became the engine that powered our decisions. It became the filter that separated truth from noise. And the more we trusted it, the more it rewarded us. Humans are naturally biased in ways most people don't even realize. And those biases show up most clearly when they try to make financial decisions. I've seen over and over that when people enter the market, they don't come in with logic. They come in with emotions, stories, news headlines, and personal experiences that have almost nothing to do with real market behavior. They see patterns where none exist. They follow trends because they feel right. They make decisions because someone on TV sounded confident, and then they wonder why the results are inconsistent or disappointing. The truth is, the human brain was never designed to handle the complexity of financial markets. It's wired for survival, not statistical reasoning. It jumps to conclusions. It seeks narratives. It gets swayed by recent experiences, and it overreacts to fear and excitement. That's precisely why intuition alone fails so often in investing. When I watched people make decisions based on gut feelings, it became clear to me that they were fighting against the very structure of the market. The market doesn't reward emotion. It doesn't care about how compelling a story might sound or how confident someone looks when predicting the future. The market responds to cold, hard data. But humans aren't comfortable with uncertainty, so they try to create certainty by telling themselves stories. They anchor their decisions to predictions that have no mathematical foundation. They cling to news events as if a headline determines long-term trends. This tendency creates a huge gap between what people believe is happening and what is actually happening beneath the surface. The moment someone says they're going with their instinct, they've already lost the advantage. Instinct comes with biases: confirmation bias, loss aversion, anchoring, overconfidence, recency bias, and none of these are compatible with rational, consistent investing. You might get lucky once or twice, but luck disguised as insight eventually disappears. Markets are too complex, too noisy, too unpredictable for anyone to rely on emotion-based decision-making and expect long-term success. That's why I chose to remove intuition from the equation as much as possible. When you remove emotion, you remove confusion. When you remove confusion, you start to see the market not as a story, but as a system of patterns, probabilities, and signals. Most people underestimate how powerful their emotions are in the market. When prices rise, they feel invincible. When prices fall, they panic. They chase peaks and flee from dips, creating a cycle of buying high and selling low. It's the complete opposite of what rational behavior would dictate. Yet it happens constantly because emotions naturally push people toward impulsive actions. The market takes full advantage of these impulses. That's why so many traders get whipsawed. The market feeds on human irrationality, and the only way to escape that trap is to step out of the emotional cycle completely. By relying on data instead of emotion, you begin to separate yourself from the crowd. You stop caring about what everyone else is excited about. You stop reacting to noise. You stop falling into the traps that the market lays for anyone driven by fear or greed. Instead, you start looking at behavior scientifically. You observe, you analyze, you test. You let numbers tell you what humans can't see. That's what gives you an edge, because now your decisions are based on evidence, not feelings. The beauty of this approach is that once you truly embrace it, your entire perspective shifts. You stop identifying with your predictions because you're no longer attached to being right. You simply follow what the data shows you, and when you let the data guide you instead of your emotions, you start making decisions that are consistent, repeatable, and grounded in reality. That's when you finally break free from the biases that sabotage most investors and begin to see the market the way it really is, not the way your emotions want it to be. Renaissance's edge never came from having smarter people or more aggressive trades. It came from being willing to gather the kind of data that most investors didn't even think was relevant. When I say we collected massive amounts of detailed, unusual data, I mean we went far beyond the traditional price charts and economic reports that everyone else relied on. Anyone can look at the same public information and come to the same conclusions. That's why those conclusions don't create an advantage. We wanted to see the market from angles no one had explored before. That meant digging into historical records, obscure pricing details, micro movements, and tiny fluctuations that seemed insignificant on the surface. Most people saw that kind of data as noise. We saw it as opportunity. because the more layers of data you examine, the more likely you are to find patterns that others can't possibly spot with the limited information they use. People often underestimate how much information the market generates. Every movement, no matter how small, has a reason behind it, but if you don't collect enough data, those reasons remain invisible. They get lost in randomness. The truth is, most investors are only seeing the tip of the iceberg. They rely on headlines, broad statistics, and surface-level numbers. They don't realize that the real insights, the ones that lead to highly reliable predictions, are hidden deep beneath the surface, buried inside the smallest details. To find those signals, you need a mountain of data. Not just more than the average investor uses, but more than they can even imagine needing. That's where the advantage begins. Gathering that kind of data requires patience and curiosity. You must be willing to examine data sets that seem unrelated at first glance. You must look for information in places no one thinks to look. Sometimes the smallest irregularity, something that happens in only a fraction of market conditions, ends up being the key to unlocking a pattern. But you only find it if your data set is deep enough and broad enough to capture every variation. Most investors don't have the patience or the commitment to build databases that large. They stop too early because they think the extra effort won't matter. What they don't understand is that those overlooked details are exactly what separate extraordinary returns from average ones. The beauty of collecting massive granular data is that it levels the playing field. You no longer have to guess. You no longer have to rely on theories that sound good but fall apart under pressure. You let the data do the talking. The numbers tell you when something repeatedly happens under specific conditions, even if the pattern is subtle or counterintuitive. And once you identify it, you can test it rigorously. You can prove it statistically. That's how confidence is built, not by convincing yourself you're right, but by letting thousands of data points confirm it for you. Some people assume this approach is about having the most powerful computers or the most advanced algorithms. But even the best algorithms are useless without the right data behind them. The data is the fuel. The model is just the engine that uses that fuel. If your fuel is low quality or incomplete, your engine will never perform at its best. That's why we prioritize data above all else. The more detail we collected, the clearer the market became. The clearer the market became, the more precise our models grew. And the more precise our models grew, the more consistent our returns became. In the end, the difference between making average gains and making extraordinary ones comes down to one thing: being willing to gather information others ignore. Most people stick to the obvious. We dug deeper. We studied what others dismissed. And that willingness to collect massive, detailed, unusual data is what ultimately allowed us to see the market in a way no one else could. When I talk about building models that can identify complex patterns, people often imagine something mystical or magical happening behind the scenes. But the truth is far more grounded. Human beings are simply not capable of processing the enormous amount of information flowing through the markets every second. Our minds evolved to handle simple, immediate decisions, not thousands of variables shifting in real time. That's why relying on human judgment alone is so limiting. Even the smartest person in the world can't compete with a well-designed model that can analyze decades of data in seconds and uncover relationships that are invisible to the naked eye. The models don't get distracted. They don't get tired. They don't get emotionally invested in a theory. They just look for patterns, test them, and keep refining themselves. In that sense, they're almost like microscopes, tools that reveal what your eyes could never detect. The patterns we were looking for weren't the obvious ones, the ones every investor can see and react to. Those patterns disappear quickly because the entire market jumps on them at the same time. The real advantage comes from discovering subtle, statistically reliable patterns that most investors don't even know exist. These patterns might be incredibly small, so small that a human would dismiss them as noise. But when a model tests them across massive data sets, across different market conditions, across decades of history, a faint signal begins to emerge. And once you find a signal that consistently appears, you've found something valuable. It's like hearing a whisper in a room full of shouting. Only a machine trained to detect that whisper can pull it out of the chaos. One of the reasons these models work so well is because they free the decision-making process from human limitations. A person might hold on to a belief even when the data contradicts it. A person might get anchored to a prediction just because it feels right. A person might hesitate to act because they fear being wrong. A model doesn't suffer from any of that. It doesn't care about being right in the emotional sense. It only cares about accuracy, statistical validation, and repeatability. It just keeps searching for patterns that meet those criteria. And when it finds them, it acts without hesitation. That's why models can outperform intuition so consistently. They eliminate everything that clouds judgment. Of course, building these models isn't as simple as feeding them random information and hoping something useful appears. You need a deep understanding of mathematics, statistics, and how to test hypotheses. You need to make sure the patterns you're finding aren't just coincidences. You need to filter out false signals and ensure the models aren't overfitting to historical data. It's a delicate balance between trusting the data and challenging it. That's why our team spent so much time running tests, breaking models, rebuilding them, and pushing them to their limits. Every model is an ongoing experiment, constantly evolving as new data enters the system. And with every iteration, it becomes slightly better, slightly more accurate, slightly more efficient at teasing out patterns that humans could never detect on their own. The key is that these models don't replace human intelligence. They amplify it. They allow us to see the market with a clarity we could never achieve unaided. They transform mountains of data into insights that can be acted upon. And once you have a model that reliably identifies patterns too complex or too subtle for humans to see, you suddenly gain a profound advantage. You're no longer guessing. You're no longer chasing trends. You're operating on hidden truths woven into the fabric of market behavior. And that's when the market starts to make sense in a way most people will never experience. People often assume that making billions in the market requires being right almost all the time, as if success belongs only to those who can predict every rise and fall with flawless accuracy. But that's a complete misunderstanding of how real long-term wealth is built. The truth is far simpler and far more counterintuitive. You don't need to be right every time. You just need a system that is right over time. That distinction changes everything. It shifts the entire mindset from trying to win every battle to focusing on winning the war. The market is too unpredictable, too chaotic, too full of noise for any person or model to get every decision perfect. But if you build a process that consistently produces positive results across thousands of trades, that consistency becomes far more powerful than trying to chase perfection. Human beings tend to measure success emotionally. If they make a losing trade, they feel like they failed. If they make a winning trade, they feel smart. This emotional roller coaster convinces them that their job is to avoid losses at all costs. But losses are an inevitable part of the journey. No strategy, no model, no genius investor has a perfect record. So the real question becomes, what happens when you zoom out? What happens when you look at the total picture instead of individual outcomes? That's when you begin to see that success isn't about the accuracy of each prediction, it's about the reliability of the entire system guiding those predictions. A system that wins slightly more than it loses, or wins big and loses small, can outperform someone who gets half their trades right but lets emotion sabotage their choices. At Renaissance, we embraced this reality completely. We didn't chase perfect predictions. We didn't expect our models to win every time. Instead, we built a framework where small, frequent, statistically validated edges added up over time. Even if a model was right only slightly more than chance, if that edge was consistent, it could generate extraordinary profits when applied systematically across thousands of trades. The key was scale and consistency. A small edge replicated repeatedly becomes a massive advantage. It's no different than the way casinos operate. They don't rely on luck, they rely on probability. They don't care if a gambler wins a few rounds. They care about mathematical expectations playing out over millions of hands. Eventually, the system, with all its imperfections, wins. The problem most investors face is that they judge their decisions emotionally. One bad outcome makes them abandon a strategy. One lucky win convinces them they're geniuses. They're constantly switching approaches because they can't tolerate the discomfort of temporary losses. But a good system doesn't need protection from losses. It needs discipline. It needs patience. It needs time to show its strength. A system that's built on data, tested across history, refined through countless iterations, will outperform human instinct in the long run because it doesn't get discouraged by occasional failures. It simply keeps executing its logic. When you understand this, you start to see the market differently. You stop obsessing over individual trades. You stop feeling personally attacked by a losing outcome. You stop tying your identity to being right. Instead, you start thinking like a statistician. You evaluate whether the process is sound. You ask if the probabilities are in your favor. You focus on improving the system rather than proving yourself. And that shift is liberating because it frees you from the emotional drama that ruins most investors. So when I say success doesn't come from being right every time, but from having a system that's right over time, I'm talking about building a long-term relationship with probability. I'm talking about trusting the math more than your feelings. I'm talking about allowing a well-tested framework to carry you through the inevitable ups and downs. And when you do that, the market stops feeling like a battlefield and starts feeling like a game where the odds slowly, steadily, relentlessly tilt in your favor. Statistical models have an ability that humans simply can't replicate. They remove emotion from decision making. That alone gives them a tremendous advantage in the market. People like to believe they're rational, but when money is involved, rationality collapses quickly. Fear creeps in, excitement takes over, panic clouds, judgment, greed, whispers in your ear, and suddenly even the most disciplined person starts making decisions that go against their own long-term interests. It happens quietly, almost invisibly. You tell yourself you're being smart, cautious, opportunistic, but really you're reacting emotionally. And in the market, emotion is the fastest path to inconsistency. One moment of fear can undo months of progress. One moment of overconfidence can erase years of gains. That's why we prioritized models that could rely entirely on probability rather than feelings. Numbers don't panic. Numbers don't get greedy. Numbers don't hesitate. When you let probability drive decisions, you free yourself from the chaos that dominates most people's thinking. Instead of reacting to news headlines or rumors, you rely on patterns grounded in data. Instead of feeling tempted by a hot trend, you evaluate whether it aligns with proven statistical edges. Instead of holding on to a losing position because you're emotionally attached to it, the model simply executes the proper action based on mathematical expectation. This objectivity creates a level of discipline that humans struggle to maintain. People can know what the right decision is, yet still fail to act because emotion gets in the way. A model never has that problem. It acts instantly, consistently, without hesitation. And in a world where hesitation can cost millions, that consistency becomes a competitive advantage. Another powerful reason these models outperform emotion is that they force you to think in terms of long-term probability rather than short-term outcomes. Humans judge decisions by whether the result feels good. They think, I made money, so I must have done something right, or I lost money, so I must have made a mistake. But that's not how probability works. A bad decision can still result in a lucky win. A good decision can still lead to a temporary loss. Emotional investors get confused by these contradictions and often abandon strategies that would have worked beautifully if they'd stayed patient. Models don't suffer from that kind of psychological noise. They follow rules that are designed to succeed over thousands of trades, not just a handful. They separate randomness from genuine patterns. They filter out noise that humans mistake for signals. Over time, this reliance on probability creates a kind of calm clarity. Instead of being tossed around by the market's daily fluctuations, you begin to see the market as a series of events governed by measurable tendencies. You stop panicking during downturns because you understand they are part of the statistical landscape. You stop getting overly excited during rallies because you know that emotions distort judgment. You start to appreciate that every decision needs to be evaluated through the lens of expected value rather than moment-to-moment emotion. And eventually, that mindset becomes second nature. It turns the market from something unpredictable and stressful into something structured and manageable. What's truly remarkable is how much emotional freedom comes from trusting the math. When you follow a data-driven model, you no longer feel responsible for predicting the future. You no longer feel the pressure to outsmart the market. You no longer feel the fear of not knowing what comes next. Your job becomes simple. Follow the system. Let the probabilities play out. Understand that consistency beats perfection. That mindset creates stability, and stability creates better decisions. It makes you immune to the traps the market sets for emotional investors. And when you reach that point, you stop competing with other traders. You start competing only with your own discipline. That's why probability-driven models win. They take the messy, emotional, unpredictable human element out of the equation. They replace it with clarity, discipline, and logic. They allow you to execute decisions that align with long-term success rather than short-term impulses. And once you start thinking this way, the market becomes less about guessing and more about following a system that quietly, steadily pushes the odds in your favor. The market is one of the noisiest environments a human can step into, and that noise is exactly what destroys most investors. Prices jump for reasons no one can fully explain. News breaks unexpectedly. Rumors spread. Social media amplifies panic and excitement. Trends form and collapse within minutes. All of this creates a chaotic landscape that feels impossible to navigate with intuition alone. When someone relies on gut instinct, they end up reacting to that noise instead of understanding the deeper structure underneath it. They buy when everyone seems excited. They sell when fear dominates. And they stay trapped in a cycle where emotion leads them from one impulsive decision to another. That's why prediction based on feeling almost always ends in disappointment. The market doesn't reward emotional reactions. It punishes them. It thrives on confusing anyone who believes they can outguess it without a systematic approach. What most people don't realize is that chaos doesn't mean randomness. Within all that noise, there are patterns, tiny, subtle patterns that repeat just enough to be useful. But they're buried so deep that no human mind can consistently notice them. The noise overwhelms perception. A person might see something once or twice and think they've discovered a trend, but that's just coincidence disguised as insight. To truly understand what's actually happening, you need tools that can dig beneath the surface. The market is like an ocean. The waves are loud, fast, and unpredictable, but the currents underneath have structure. If you try to navigate by staring at the waves, you get lost. If you learn to read the currents, you move smoothly. The trouble is that humans are naturally attracted to the waves because they're visible and dramatic. Models, on the other hand, ignore the drama and focus on the measurable forces underneath. This is why intuition fails so reliably. Intuition reacts to the most visible movements, the most emotionally charged signals, the most recent events. It's pulled into the noise. A person sees a price spike and assumes something meaningful is happening. They hear someone make a bold prediction on the news and assume that person must know something. They feel fear when a market drops and assume it's time to escape. But these reactions are simply responses to the surface-level noise that constantly misleads inexperienced and emotional investors. The noise gives the illusion of insight while providing no actual predictive power. It creates confidence without accuracy. And confidence without accuracy is one of the most dangerous combinations in investing. Models don't get fooled the way humans do. They don't get distracted by what's loud or exciting. They analyze quietly, methodically, statistically. They look at thousands of scenarios, millions of data points, decades of market behavior. They test everything instead of trusting appearances. They seek consistency rather than drama. And because of this, they detect the faint signals that intuition overlooks. These signals might be incredibly small, almost invisible in the moment, but when applied systematically across thousands of trades, they produce reliable results. While humans are chasing big moves and emotional headlines, the models are quietly exploiting patterns so small and subtle that no individual investor could ever notice them. This is why gut-based predictions fall apart so quickly. When someone tries to anticipate what the market will do based on feeling, they're essentially trying to predict noise. They're leaning into the most unpredictable part of the system. The market's movements are influenced by countless factors: algorithms, institutional flows, global news, micro delays, liquidity gaps, far too many for any person to track. Intuition simplifies complexity into a story, but the market isn't a story. It's a statistical environment. When you treat it like a story, you get misled. When you treat it like a statistical system, you finally begin to see its true nature. The moment you stop reacting to noise and start analyzing data, everything shifts. You stop feeling overwhelmed by volatility. You stop feeling tricked by random spikes. You stop mistaking coincidence for insight. Instead, you begin to understand that the key to navigating chaos is not to outguess it, but to measure it, to observe it with tools capable of separating real signals from illusions. The models do that job far better than humans ever could. They ignore the noise that intuition chases, and in doing so, they uncover the opportunities hidden beneath the chaos. When I think about why most people struggle in markets, it often comes down to one simple issue. They become prisoners of their own assumptions. They cling to what they believe should happen rather than what is actually happening. I learned early that the markets don't reward conviction. They reward correctness. That's why my entire approach was built on questioning everything, every belief, every pattern, every result, every comfortable thought. I wasn't trying to be right in a traditional sense. I was trying to uncover what was true beneath the noise, beneath the stories people told themselves to feel smart or secure. That habit of questioning didn't come from distrust, it came from curiosity. I just wanted to know why things behaved the way they did. Most people look at the market and see a battlefield. I looked at it and saw a puzzle. And the first rule of solving a puzzle is never assume the picture on the box is accurate. Question the pieces, question the shapes, question the colors, question why the pieces even exist. And once you do that, once you stop assuming and start observing, you start noticing things others miss. You see patterns that don't seem important at first. You see little inconsistencies. You see behaviors that don't align with the stories the market is telling. And once you start seeing those things, you begin to understand that the market is full of signals, tiny whispers that most people ignore because they're too busy focusing on predictions instead of possibilities. I always believed that data is only valuable when you interrogate it. You can have oceans of numbers, but unless you look at them with a questioning mind, they won't reveal anything meaningful. I wasn't satisfied with surface level explanations. If something rose, I wanted to know why. If something fell, I wanted to know why. If a system behaved unpredictably, I wanted to know what variables were being overlooked. That constant questioning didn't just sharpen our models, it protected us from overconfidence. Markets punish overconfidence more brutally than anything else. The moment you think you've figured everything out, the market will remind you that you haven't. Even inside my firm, I encouraged everyone to challenge ideas, including my own. I didn't want people who nodded their heads. I wanted people who challenged assumptions. Scientific progress never came from agreement. It came from the friction between ideas. That friction forces you to refine, rethink, recalculate. In markets, that refinement process is everything. You don't get paid for having a brilliant insight once. You get paid for questioning that insight again and again, stress testing it, breaking it apart, and rebuilding it. That's how you end up with strategies that survive not just one market cycle, but decades of change. Most people never question their biases. They fall in love with a stock, a prediction, a narrative. They become emotionally invested. When you question everything, you remove emotion from the equation. You're not defending a belief, you're exploring a possibility. That shift alone dramatically increases your chances of seeing reality as it is, not as you wish it to be. Reality doesn't bend for anyone, not even the smartest investor in the room. But if you study it without emotional attachment, it becomes a guide rather than an opponent. Questioning everything also taught me humility, not the superficial kind, but the real kind, the kind that reminds you that no matter how much you know, there's always more you don't know. That humility became a strength. It made me cautious, careful, and methodical. It prevented me from making reckless bets based on ego. When you're humble, you double-check the data. You run one more test. You look at the possibility that you might be wrong. And often, that extra moment of caution saves you from disaster. People sometimes assume questioning everything leads to paralysis. It's the opposite. It leads to clarity. When you challenge your assumptions, you eliminate noise. You remove illusions. And once you remove illusions, the truth stands out with sharp edges. That truth becomes your compass. It becomes the foundation for decisions that aren't based on hope or fear, but on understanding. Discipline is not something you apply once. It's something you apply constantly, especially when you don't feel like it. Markets have a strange way of testing your patience, your conviction, and even your sanity. That's why discipline becomes the backbone of any sustainable strategy. Without it, even the smartest ideas collapse under pressure. I wasn't successful because I always knew what would happen. I was successful because I stuck to a process, even when every emotion in my body wanted to abandon it. Discipline wasn't an optional skill. It was the cost of admission. Most people understand discipline in theory, but fall apart in practice. The moment the market becomes volatile, emotions kick in. Fear whispers that you should sell before things get worse. Greed whispers that you should chase something that's running. Both voices feel urgent, loud, and persuasive. If you don't have a disciplined process, you'll follow those voices right into mistakes. I built systems because I didn't want to rely on emotional judgment. Emotions are great for human connections, but they're terrible for decision-making in markets. A model doesn't get scared. A model doesn't get excited. A model simply evaluates information and acts according to rules. That kind of consistency is impossible for humans to achieve without structure. Discipline also means accepting that sometimes the system won't give you the result you want. There were plenty of days where the numbers didn't look great, where the models weren't producing big returns, and where the temptation to tweak or interfere was overwhelming. But that's exactly when discipline matters most. Anyone can follow a system when everything is working. The real test is whether you can follow it when the world feels like it's falling apart. I learned that disciplined behavior in moments of uncertainty is what separates long-term winners from short-term survivors. The market rewards those who stay steady when others panic. People often imagine discipline as something rigid, almost mechanical, but that's not how I see it. Discipline is flexibility applied with structure. It's not about refusing to adapt, it's about refusing to react impulsively. If new information emerges and the data supports a change, then change is the disciplined thing to do. But if you're changing your strategy because you're anxious, bored, or afraid of missing out, that's not adaptation, that's instability. And instability in markets is deadly. Discipline protects you from your own worst instincts. There's another part of discipline that people underestimate: repetition. Real success comes from doing the boring, unglamorous things consistently. Running tests, cleaning data, reviewing parameters, checking results, challenging assumptions. None of these tasks are exciting, but they're essential. My team and I repeated those processes thousands of times. It wasn't luck that produced results. It was the cumulative effect of disciplined repetition over years. Most people want the thrill of breakthrough moments, but breakthroughs are built on an endless foundation of mundane consistency. Discipline also requires something many people overlook: the ability to do nothing. Sometimes the best action in the market is no action at all. But humans feel compelled to intervene, especially when things don't move as expected. They want to fix something that doesn't need fixing. Waiting feels uncomfortable, like a form of failure. But disciplined patience is often more profitable than frantic decision-making. A strategy doesn't need constant interference. It needs stability. And that stability comes from knowing when to stay out of your own way. Over the years, I saw countless investors with brilliant minds but poor discipline. They could solve complex mathematical problems, but they couldn't resist the urge to second-guess themselves at the worst moments. Intelligence without discipline is like having a powerful engine with no steering wheel. It might move fast, but it won't move in the right direction. My advantage was never that I was the smartest person in the room. It was that I trusted the process more than I trusted my impulses. Discipline also builds resilience. When you follow a structured process, You develop the ability to bounce back from setbacks because you understand that losses aren't personal, they're data, they're signals. They're part of the broader pattern. When you detach your ego and rely on discipline, you stop seeing losses as failures and start seeing them as feedback. That mindset keeps you calm. And calmness is an investor's greatest asset, especially when everyone else is losing theirs. The lesson I've learned above all else is that success in markets comes from trusting data over instincts. Human intuition is powerful in everyday life, but in investing, it's often your worst enemy. Your instincts are shaped by your experiences, your biases, and your emotions. They make you feel confident, but that confidence can be misleading. You think you understand a trend, you think you can predict what's next, you act on a hunch, and the market humbles you. The harsh truth is that the market is far more complex than any individual can fully comprehend. It doesn't care about your experience, your knowledge, or your gut feeling. It moves according to forces too numerous and interconnected for one human mind to predict reliably. That's why data must become your guide. Data doesn't get tired. Data doesn't panic. Data doesn't make decisions based on ego or hope. It simply tells you what is happening and, when properly analyzed, what is likely to happen. The moment you start relying on data rather than instinct, you start seeing the market differently. You begin to understand that outcomes are probabilistic, not deterministic. You learn to think in terms of probabilities and patterns rather than stories and feelings. And once you embrace that mindset, your entire approach changes. You stop trying to predict the unpredictable and start focusing on where the edge exists, no matter how small or subtle it may appear. One of the biggest advantages of trusting data is that it forces objectivity. Emotions cloud judgment. They make you overconfident when things go well and paralyze you when things go poorly. They make you chase trends or cling to losing positions for no rational reason. When you rely on data, decisions are grounded in evidence. You can test your assumptions, measure outcomes, and adjust strategies without being swayed by fear or greed. You create a feedback loop where results, not opinions, dictate your next move. That feedback loop is incredibly powerful because it removes human error from the equation. Another aspect of trusting data is that it allows you to identify patterns invisible to intuition. Most people rely on what they can see or feel, which means they miss subtle correlations, hidden relationships, and statistical anomalies that the numbers reveal. Data exposes these opportunities, and when analyzed correctly, these insights become actionable. That's where extraordinary returns come from, not from lucky guesses or clever tricks, but from a systematic approach that detects and exploits patterns consistently. The more disciplined you are in following the data, the more predictable your results become, even in a world that feels unpredictable. Trusting data also creates patience. Humans want immediate results. We want validation that we were right. We want to feel smart in the moment. But the market doesn't work that way. A well-researched insight may take weeks, months, or even years to play out. If you rely on instinct, impatience often leads to premature decisions. But when you follow the data, you develop the patience to wait for the probabilities to align, to let small edges compound, and to trust that the process works even when individual outcomes feel uncertain. Patience and discipline go hand in hand, and both are rooted in trusting evidence rather than emotion. Finally, relying on data over instinct doesn't just improve your decision-making, it changes your mindset entirely. You start to see losses not as personal failures, but as information. You start to see volatility not as chaos, but as opportunity. You start to see the market not as a test of your intuition, but as a system governed by rules and patterns that can be understood and exploited. Once you internalize that, everything shifts. Your decisions become calmer, more consistent, more rational. And in the long run, that calm rationality is what separates those who consistently succeed from those who chase their instincts and fail repeatedly. When I look back on what made our approach work, it wasn't a secret formula, a lucky break, or a stroke of genius. It was a commitment to seeing the world as it actually is, not as we wished it to be. It was about collecting every piece of data we could, analyzing it without bias, testing ideas relentlessly, and trusting the results rather than our emotions. The markets are unpredictable, and there will always be surprises. But if you build a process that's grounded in evidence, disciplined in execution, and patient in waiting for the right opportunities, you create a system that can withstand chaos and turn it into advantage. I've always believed that the human mind is remarkable, but it has limits. Data allows you to push past those limits, to extend your understanding far beyond what intuition alone could achieve. It doesn't guarantee that every decision will be perfect, but it gives you the ability to make decisions that are consistently better than guessing, consistently better than hope or fear, and consistently aligned with long-term results. That's where true success lies. Not in being right every time, but in having a method that's right over time. If there's one piece of advice I could give to anyone who wants to succeed in investing or in any field where complexity and uncertainty dominate, it's this: trust evidence over instinct, patterns over stories, probability over certainty. Learn to question assumptions, to test relentlessly, and to stay disciplined even when the world seems chaotic. Embrace data as your guide and let it show you opportunities you never would have seen otherwise. Over time, that approach compounds not just your results, but your understanding, your clarity, and your confidence. That's how you turn information into insight, and insight into outcomes that few others can achieve. At the end of the day, it all comes down to one simple truth. The market doesn't reward luck or emotion. It rewards clarity, consistency, and the courage to follow evidence wherever it leads. And if you commit to that path, if you let data guide your decisions and discipline guide your actions, you give yourself a chance to play the game on an entirely different level, to see what others can't, and to create results that feel almost impossible until you realize that it was never about magic, it was about method.